investment sort of guidelines, if you will, and you boil it down to what's called an asset mix. So basically, as most folks will know, investors, there's different classes of assets. Fixed income, bonds, equities, precious metals, currencies are often considered now an asset class. Cash itself is an asset class. And you set down some, so as an investor, you'd take these goals and objectives and you would set down and say, okay, I'm a balanced investor. I want moderate growth. I want to have a component of bonds. I want to have a component of stocks. I want to have a component of short-term cash reserves. And so why do you do this? Why would even a long-term investor have an asset mix with different asset classes in it? Well, the reason is diversification. Okay. Good example, for example, pure growth investors over the last year suffered if they were
the worst of anybody.
If you had an asset mix which had a component of bonds, say 40% or so forth, of course you gained a little bit on your bonds and it mitigated the decline in the account. So you had somewhat of an offset. So you take your goals and objectives and you articulate them into an asset matrix, mixed matrix, and then your money manager or your advisor works within these constraints. And sometimes you can say, well, Mr. Money Manager, I always want a minimum of 40% stocks, but you never are allowed to go above 60. I'm going to give you the authority to manage within that range.
So you're a discretionary money manager.
Right.
You actually legally have the right to, if your customer or your client gives you permission or instructs you to do so, you can buy and sell securities in their name without having to ask them about every individual sale. Now, not very many brokers have that right, am I correct?
Some do. I mean, you know, there are licensed portfolio managers at brokerage companies. There are money managers such as myself and who manage money as from an independent point of view or organization. Large ones and small ones. We happen to be relatively small, as you know. But we all sort of follow most professional money managers or chartered financial analysts is the designation most professional money managers have here and around the world. And we all follow the CFA Code of Ethics and the sort of parameters of professional money management that we all sort of agree to adhere to. So the professional code of ethics.
But you're all following that code and that general thing, but there's still going to be variety among you in terms of maybe one person a little bit more into natural resources, or you can't be cookie cutter, can you?
No, you can't be cookie cutter. I mean, there's different management firms that have different styles. I mean, you'll have professional money managers that use a value style of investing, others that use a momentum style of investing. It's similar.
We're going to have to do some definitions. I've interrupted you. Let's get back to what you were talking about.
Okay, so back to the investment policy statement. I guess the point I want to make is it's always, everybody has to have a plan. You should update it frequently, certainly annually. I bring this up because I think it's worth mentioning that often, and not always, but often, clients sort of give money managers their money. And they say, here's my account or whatever, and they sign up with this management agreement, and then they walk away and they assume that the money manager is going to do everything.
Yeah.
And the client doesn't get that sense of responsibility, that they are in charge of the policy. If there's to be a change of policy for whatever reason, they have to come forward and sort of tell the money manager they've changed, whether the personal circumstances have changed or so forth. Often, and arguably, I think, certainly in good times, this whole thing, as I said, the policy development issue, the actual asset management issue is thrown to this money manager, and he's responsible. The client thinks that they're responsible.
That they're going to do it all.
Let me give you an example. Okay. This is going back into the tech wreck. when I was managing.
Oh, okay.
Back
2000,
2000
the fall
so
of the spring of 2000. You're talking.
It was very the rage, of course, across in the investment world was wrap accounts.
Yeah.
Go to a broker, and he would have a roster of 10 or 15 different money managers, and they would say, you know, pick based on historical performance or whatever. You pick this one, you pick that one, and so forth. And so you'd say you have your $500,000 and you put 250 into this money manager and 250 into that one. Well, and of course the market in those days, as you know, had tremendous declines and so forth. And so in review, we looked at this and said clients were unhappy with their performance. Well, when we look back and said, well, why? Where did things break down? Why, you know, the clients would come in or would ask, you know, not whose fault was it, but who dropped the ball here? Mm-hmm. So you ask the question in these wrap accounts is that the client comes in, he signs an investment policy statement, he hires these two money managers through the broker. What's the broker's job? And what is the money manager's job? Well, the money manager's job is to invest the money he's been assigned, say the $250,000, to his growth mandate or whatever mandate was chosen, and to be arguably 100% invested in that strategy. It's not his. When you're giving him the money, he's going to put it to work, okay, regardless of market circumstances. So the money manager, when you phone up and say, "Hey, my things are going down. Why is my money manager in cash?" Yeah. Well, it's not his decision because you've hired.
Oh, you told him that you wanted it there and there.
You said you wanted a growth mandate, 100% equities in that manager. So you've tasked him with being 100% invested all the time. It's not his job to change the asset mix. So if it's not, and of course the broker doesn't make the investment decisions because he just sold the product. So who was responsible for this? Was it the client by not articulating his objectives better and policy within the circumstances? Was it the broker who should have changed, you know, arguably should have said, I want you to reduce the allocation of this money manager and put it in cash? Or was it the actual money managers who were tasked with managing the money?
Who should have gone to the client perhaps and said, do you think we should change this?
Right. But as always, there's always these little hooks. For example, in the wrap business, you have minimums. You can't, if you have $250,000 as a minimum for this wrap program, you can't cut it back by $50,000. It's an all-in or all-out situation.
Okay.
Right. So
I'm learning from this, by the way. I really appreciate that, and I hope that other people out there are learning too. And well, it's not dull.
It goes to the issue of.
I've been doing this for 56 years and interviewed 100 people on money, and you're putting this. It's a new world out there, though, and you're putting it.
Well, wrap accounts, these types of accounts are relatively new over the last several years. But so as a client, you look at the situations. You have to retain the power of policy as a client. You retain that power, and it's up to you to provide the policy direction to your people.
Well, you're saying it's up to me. But isn't there some responsibility on the money manager to phone me and say, what do you want to do?
Right. So basically, as a money manager, if you're an investment advisor, you phone up typically it's an annual review. So it's stipulated in the agreements and so forth that you as the client are going to bring forward any kind of changes. Say, for example, from a personal point of view,
you got married, you got a divorce,
whatever,
you're given 6 months to
so
live
you got to
house.
change your direction, right? But typically the money manager industry provides a quarterly.
Do you need a glass of water or something?
I'm good. So I do have a bottle of water over there, Richard. If you see it there, that'd be great.
Maybe find me my Coke too, my cola, my Diet Cola.
So typically, money managers give a quarterly review, and then annually you go through and you review the policy statement.
Yeah. So
the only other time, if there's market conditions or so forth, and a good advisor will say, do you want to change anything? Right, and get in front of it for you. So just to sort of summarize, I don't want to bear down on this too much, but the policy issues are important.
There we go.
Yeah, thank you.
There's some water for
you. And
it's I've got myself a bit of a cola.
worth reconsidering. A lot of But you'll find a lot of advisors, for example, will have a KYC, which is just your name, address, your your financial status, you tick off, are you an aggressive investor, balanced investor, or conservative investor. So it doesn't really articulate more than just the basics. The more direction you can give to your investment advisor, the better job he should be able to do.